Well, joining me on this Friday morning is James Demmert, CIO of Main Street Research. Happy Friday, James, and Happy New Year.
Happy Friday, Remy.
Well, on this Friday morning, we are looking at U.S. stocks higher, and this does come on the heels of the jobs report. Now, non-farm payrolls coming in lower than expected on the heels of revisions, but also the unemployment rate lower. So what does all of this mean?
Yeah, I think it means a lot. Investors really want to focus here. People have been worried about that labor market, and this shows it's stabilizing. And that tells us that the Fed probably doesn't need to cut as much as maybe people had thought. The economy is very strong. You know, you link that with the GDP number, the last one, 4%. This is a strong economy, 4.5% employment. You know, employment typically is 5-6%. We sort of forget that. We've got a really good economic climate here. I think it's a great setup for equities.
Mm-hmm. And speaking of which, we are looking at U.S. stocks higher this morning, and we saw the Dow and S&P 500 hit new records earlier this week. But you mentioned the Fed Reserve, and obviously we are counting down to the Fed meeting at the end of this month. Right now, the probability of the Fed staying on hold is at 95%. But you mentioned the U.S. economy and the growth that we saw last year. So walk us through the macro outlook for 2026.
Yeah, I think that investors here want to focus on a macro level. The Fed's not going to be part of the picture. Look at productivity growth. Wow, It's at 4.9%. Now, a lot of people wonder, what does that mean? Well, typically productivity growth has been around 2% for the last 5 years. So what you're seeing is artificial intelligence is enhancing that productivity growth. What that does for earnings is it allows them to catapult higher than normal. So where we typically might expect a 9 or 10% earnings for the market, we're expecting the S&P 500 might have 15% growth in earnings this year. So from a macro standpoint, the Fed doesn't really need to be a part of this. Productivity growth, strong economy drives those earnings. And I know a lot of people are worried, well, 22 times, how can we go higher?
Yeah.
Right? I think that comes up a lot. And we have to remember that most of the market is not at 22 times earnings. Those Mag 7 are. We got a lot of the market that didn't do a lot last year. Those stocks are trading at about 16, 17 times earnings. Lots of opportunities in other parts of the market.
Yes, I think you mentioned a key word there, opportunity for the markets, and we're here on Wall Street. So tell me where you're seeing opportunity.
Yeah, I think that's important as well. The consumer sentiment numbers came today. They were not pretty. So I think as an investor, you want to focus on sectors where robust profit growth and productivity are occurring. So it's really not in the consumer discretionary area. I don't think it's in energy because Venezuela is just putting more oil back on the market. Focus on tech and telecom. That's an easy one. But now you can see with the Dow doing better than the S&P this year, it's the industrial stocks, it's the financials, it's the healthcare stocks, which were in the doghouse last year.
And of course, 2026 is also a midterm election year. So tell us about the setup as we head into 2026.
Yeah, that's going to be a lot of moving parts. You got this administration is going to try to look as good as possible and do some things that might rattle different parts of the market. I think the most recent one was Trump's policy on going in and buying private homes and telling BlackRock they can't do that. And so I think investors should expect some volatility with this midterm election year. And don't forget, a normal market has about 2 or 3 10% corrections a year. I think this year is going to fit very nicely into that kind of market.
Yeah, and you brought up an important point there. We're only 9 days into the new year, the month of January, but if this week is any indicator, we're likely to hear announcements coming out from the Trump administration. But in reality, in terms of what ends up happening and what sectors are actually affected, we'll have to wait to see how all of this shakes out. So I have a behavioral investing question for you. Do you think investors are getting too complacent when it comes to risk?
I love behavioral finance, so thank you for asking that question. And what's interesting is we look at the institutional levels of cash levels, we look at independent polls of individual investors, and what's strange is that people seem to be complacent when they talk about the market, but what they're actually doing is there's higher cash levels than normal. So there's a little bit of what I call is a mildly bullish environment. So it's not excessively where you do get worried of, oh, that's going to make the market maybe take a very big tumble. So we've got a bit of a cautious investor psyche when it comes to what they're doing. And I think that means that there is more upside, and as investors sort of call the wall of worry, as we call it.
Yeah, and James, I'm also glad that I have you here today because next week earnings season gets underway. Hard to believe given that the new year has just started. But of course, we're paying attention to the big banks. We start off with JP Morgan Chase, followed by Citi, and we also get Bank of America, Wells, Goldman Sachs, Morgan Stanley next week. So what are your expectations? And also with all this deal-making activity, what can we expect from the big banks?
Yeah, here they come, Remy, right? And we're excited. We think that the financial stocks could be what the tech stocks were last year. There is a lot of valuations are reasonable, a lot of IPOs coming down the pike, a lot of M&A, and you've got dereg, of course, coming to the banks, and they're starting to see that. And that part of the market is leveraging AI a lot more than investors expect. So we expect really good numbers, not just from the U.S. banks that you mentioned, but HSBC, Barclays overseas, very good places to be.
Yeah, and you bring up an important point because it's not just U.S. banks. And when we take a step back and look at the performance of overseas equities, we'll be keeping an eye on emerging markets as well. Give us your base case as well as bull and bear case, not just for U.S., but also overseas.
We're a global manager, so 40% of our positions in equities are outside the U.S. And we think that's even more attractive than the U.S. We're very bullish. Valuations overseas are about 50% of what they are in the S&P 500. So attractive on valuation. And institutional and individual investors are not positioned in those markets. So now that those markets are outperforming the U.S., I think you're going to see a migration, like let's say a FOMO trade, to getting back into those foreign markets. And investors, I would suggest, stay in those really great companies that have strong balance sheets outside the U.S. HSBC, Siemens, AstraZeneca, Taiwan Semi, which is one of our biggest holdings.
Yeah, and finally, before I let you go, do you have any specific price targets here?
On the S&P 500, hold your hat here. 8,100 is about 17% from here. Foreign markets we think will do better. And by 2030, get this, we think the S&P goes to 15,000. The Dow goes to 100,000.
Well, those are some lofty targets here. So before I let you go, for viewers out there, we have about 60 seconds here. For American viewers who are wondering what all of this means for their everyday lives in terms of the economy, what would you say to them?
I would say embrace AI, right? If you're working, embrace AI in your job. People are worried about their jobs now because of AI. Just embrace it. Let it allow you to be more productive at work. And the economy should be perfectly fine and safe. This should be a good 3-4 years left of this business cycle.
Well, James, it was great having you on the show today. Thank you so much for joining me, and thank you so much for sharing all of your insights.
Remy.
My pleasure.